Good morning, everybody, and welcome to our national Q&A call. Today is the 29th of November, 2022. It is 9:02 a.m. Pacific, 12:02 p.m. on the East Coast. We're going to get started right now with news you can use. Today's topic, where have all the investors gone? They have disappeared all through the country. Another subtitle of this would be Why Burr is Dead. B-R-R-R-R-R-R-R. And we're going to talk about that coming up. All right, so Jerome Powell, the head of the Fed, arguably created this economic crisis that we're having right now. Their attempt to battle inflation by raising interest rates at the federal level and continuing to raise them has caused havoc in a lot of industries, not the least of which is ours here in the housing industry. And they've done that by raising rates faster than the market expected. Nobody planned ahead, and we got caught short-sighted, flat-footed, whatever the proper terminology is here, but they are acting aggressively, and it is causing a lot of problems. And what's happened is in a very short period of time, in about a 6-month period of time, interest rates have gone from, for buying houses, have gone from in the range of 2.5% to 3% on up to 7% and a little bit higher in some cases today. And what that has done is that has taken, and this is the simple explanation, I'm going to break it down in a little more detail. That has taken the profitability of a Burr type model, which is buy a property, repair it or rehab it, re-rent it, put a property tenant in there, and then refinance it, and then repeat that whole process. That has taken that model completely out of play. Burr's dead. And the majority of these investors out there who were doing, believe it or not, who were doing rehabs were actually Burr investors. They were some derivative thereof. They were people who not only intended to, flip properties, but they primarily flipped them for their own portfolio to add a lot of profitability. I think of a buddy of mine here in Central California who's done this for 2 or 3 years. He has a large real estate company. He's a big investor, and he's done it. And I remember talking to him the day he started doing this, and I said, this is not a good business model. It's not a sustainable business model because you don't get your profit out of the property. You end up high-centered with higher loans at a high LTV because you get really good at borrowing, and there's no long-term gain that you're going to get out of owning a bunch of rentals unless you plan to live there for 30 or 40 years, have your tenants pay them off, the old Carlton Sheets model that we've talked about in some previous episodes. Long term, that's just not a good model, in my opinion. So he's gone ahead and done that. Now he's got a problem. It's always cash flow with landlords. You end up with too many properties, with too many tenants that aren't paying, and so you end up with that kind of an issue. And all of those investors have gone away because of what the Fed has done. So today, even with investors who say I'm paying cash, what that means is they've got some kind of a floor loan or an inventory general umbrella type loan, some kind of property based loan that gives them access to a ton of cash. We all do it. And then that cash becomes your war chest to go out and buy the properties. And you can say legitimately, because it's in your bank account, I have cash and I'm going to buy with cash. And so that puts you in a primary position over somebody who's got to have a finance loan. So these guys are borrowing the money even though they've got cash, but today they're borrowing at 7, 8, 9%. And if they've got a property, most of these Burr properties were only making 3 or 4%. When money was 2.5%, that was a good deal. You could almost double your money in some cases with a 5% cap rate or 5% return. So in other words, you spent $100,000, it brought in $5,000. That's a 5% return, or 5 cap is the way they look at that. But if your cost of funds are 7 and you're only bringing in 5, you're screwed. You cannot make the thing work. So keep in mind, one of the first big lies we need to dismiss is that these investors who say they have cash, we think of it as, they've got a big IRA stuffed full of money and that kind of thing that they're using. That's not the case. They're using floored plans, or they're using large lines of credit, or they're a hedge fund and they've got contributions in there, but they do have a cost of funds. And that cost of funds has now risen where there's an inverse model between the cost to reborrow money and the cost, the profitability you can make on a property. So all of those guys have disappeared from the market. They're not in play out there at all. And as somebody who's really active in the market on a day-to-day basis, I can tell you that we're having very little competition from other investors out there buying properties. Some of these sellers are still lying and telling you, oh, I've got 3 or 4 guys giving me a quote. Never happens. What we've done now is we've implemented a policy on our buy team that says we're going to offer a first price. And if they come back and say, we want your best and highest, we will automatically drop the price. If they want to delay us, we will drop the price. If they want to drag it out and say, we got to wait a week or 2, we will drop the price, because we know our competition is not a cash buyer real estate agent anymore. Now, with few exceptions, that's the case. So you don't have to worry if you're out there competing to buy something for cash. In most cases, you don't have to worry about a bidding war anymore at all, even though in some of these sellers' minds, they think there's something going on out there. They think that, everybody wants my house and I want multiple bids on my house, that kind of thing. But the bulk of the investor activity is gone. Now, there's a lot of guys out there playing for Airbnb. There's still a fair amount of us out there doing flips type thing, but we're the small piece of the big pie. Most of the big pie is landlord business. We've talked about this in the past. There are approximately 28 million landlord-owned single-family homes in the U.S., and on an annual basis, something between 600,000 and 800,000 homes get flipped. So you do the math. I mean, the size of the rental market is 35 or 40 times larger than the flip market. So the rental market people, at least from the Burr model, are basically disappearing from the market. The large hedge funds went away. The large Burr investors, even the mom and pop Burr investors, are going bye-bye. Now, there's some markets where, and these are the markets you're going to see the biggest crash. There are some markets where there was so much investor activity that the drop in number of sales of homes to investors is so high now that it is flipped around, and the organic buyers have a distinct advantage today, but there is no investor activity. And so they've rated, let me find this little chart here and I will read it to you. There are a number of markets in the U.S. I cannot find it, but anyway, I was going to tell you the top markets where the investor activity has disappeared. I remember the top 4. The top 4 were Austin, Texas, Salt Lake City, Boise, and Sacramento was in 4th place. And these were the biggest markets where the investor count has dropped, and it is putting organic buyers, at least for those 4, there was, I think, 20 cities on the market. I'll try and find it and post it. But those cities are cases where the organic buyer now has a distinct advantage because they don't have to compete with higher bid prices and things like that to beat out an investor. So somebody wants to live in a home if they can afford those kinds of interest rates. Unfortunately, in almost all those markets, regular buyers can no longer afford a 7-8% interest rate. So they're priced out of the market too. What's that do when organic buyers can't come in and pick up the slack that investors are left behind by leaving the market? It causes big price drops. So Phoenix was the 5th one on the list. Phoenix is right now projected to have the biggest loss during this downturn, which if you look at some previous deals that we've done, we've talked about, I don't think the downturn this go round is going to be as big as it was before or as long. But Phoenix, I think, will lead the list with a 35%. This is my prediction, a 35% price drop from the top earlier this year to the bottom, which probably will be in about 2 years' time, something like that. Those other markets will see something north of 20, but below 35%. And there are some markets across country they're going to survive unscathed. They're going to have very minimal reductions in prices. So anyway, that's something to look forward to out there for the next couple of years. If you're an investor in the business, you're probably one of only a few that are out there compared to what was there before. It's a golden time to be in the business because there are more sellers, there are more buyers, there's more levels of business activity if you can figure out the money component where money is needed. And there's a lot of ways around that. There's a lot of ways to skin a cat, and that's the kind of things that we teach in our courses. All right, that's it for news you can use today.